I've actually, as you can probably see, modified the title a little bit. What are the events that shake our world? It's a little more manageable, don't you think? Modeling and hedging GEOVOL. So this is a research topic which I think has it's a natural question for people in financial markets to ask, and it has a lot of different implications that we'll talk about in a minute. But let's start by let me tell you a couple things about me. The Volatility and Risk Institute is an institute at Stern. It's located in the finance department, and it's focused on measuring and managing many different kinds of risks that impact the financial system. And so geopolitical risk is kind of a natural outgrowth of this way of asking questions. What are the risks that we worry about? And I'm going to show you a bunch of things from our website as we go tonight, which is called VLab, which stands for Volatility Laboratory. And if you Google VLab at NYU or something like that, it'll come up immediately. And what it does is it displays hundreds of thousands of data points every day, which are useful for information for risk managers and people who are making decisions. So when something bizarre happens, actually you don't have to build your own model. You can go to VLab and see what the model is saying, because these models get re-estimated every day. And it's a kind of a novel way of doing economics, because we typically have a data set and you analyze this data set. But you don't really know when you get new data whether the same model is going to fit that data. And so when we write a model down for the VLab, we have to give enough code so that it can run not just on the data that it's got, but it can run on data that we haven't seen yet. It runs every day without anybody managing it, and you get the results up here. And well, sometimes there's a glitch in the data, and sometimes things happen, and it shows up immediately. But anyway, it's a sort of an interesting notion of out of sample. It's really out of sample. So in VLab, we've traditionally focused on financial risks such as volatility and correlation, liquidity, long-run value at risk, and fixed income risk. Probably the most widely used part of VLab is the systemic risk section, where we calculate the capital adequacy of several hundred major banks around the world on a weekly basis to see if they can withstand the stress test that a hypothetical change in value that we postulate. And this is used by regulators and is a nice resource. We're going to talk about geopolitical risk tonight, and I'm going to show you both country and asset class models. And we're also focused on climate risk. We have a section on that, on the performance of climate-based funds, ETFs and other kinds of funds, and what kind of volatility you expect from holding these funds. We also have a section on cyber risk and pandemic risk, which don't exactly have a lot of answers in them, but they have, these are topics we're working on. So here's the motivation for the talk. So this is our volatility map. And when you go to VLab, that's the first thing you see. And so where it's green, it means that the equity volatility of this country is low relative to historical levels. And where it's red, it's high. And we update this every day. In fact, if this were a live screen and you hover over a country, it gives you you dig down and you can see sectoral volatilities, and then you can dig down and you can see individual firm volatilities. It's all kind of under the surface here. And this is what it looked like, I guess, this morning. But this is what it looked like after Brexit. So you see, all of a sudden, not only did the British stock market go crazy, but all of Europe turned red in just 2 days. The Commonwealth, if you think about it, Australia, South Africa, Canada, all turned red. Trading partners like Japan and so forth. So a lot of red. And the US, absolutely, definitely. If you look at last spring, in March, when the pandemic really hit its stride, you can see it's even more red everywhere. Almost every country had stock market which turned red. So one of the things we see when you plot volatilities of different assets, and this is, these are sectors, commodities, real estate, and a bunch of things. They all have volatilities which peak at the same time. And we want to ask a little bit about why that happens and how it happens, and what kind of models it takes to make that happen when you build a multivariate model. So the common view as to why, this is a finance view, why volatilities peak at the same time is that there's some risk factors. And these risk factors actually peak, and that drives lots of different assets to have their peak at the same time. But it turns out if you take out these risk factors, and so that you have just idiosyncratic volatility, idiosyncratic returns left over, they also have the property that they peak together. And so it isn't really just the risk factors that make volatilities rise together. It's something about the shocks that are common, that they're the same kind of shock affects all these markets in a way that is not just picked up by the factors. So we're going to ask what these shocks are. How do we estimate them? How do we build a model that looks at these? How big are they? How would we hedge them? And so we're interested in shocks to volatility that are in all countries of the world, in all asset classes at the same time. So another way of saying that is if you have one of these volatility models, sometimes it predicts correctly, but sometimes it underpredicts volatility and sometimes it overpredicts volatility. On average, they're unbiased, but not every day. So when are these volatility models dramatically underestimating the volatility of some asset and all the other assets at the same time? They're missing all these assets at the same time. That's the event we're looking at. So, because these are gigantic risk events for investors, since your portfolio really doesn't have much diversification if there's this kind of event. And so the question is, how can you prepare for them, or can you prepare for them, or how does this affect your asset allocation? So we're going to call this GEOVOL, this event that makes all these asset returns get high. I've called it geopolitical risk, but referees haven't really liked that very well, because some of the risks are what you would, it isn't really clear what we have in mind when we say geopolitical risk. But anyway, for some of the people who reviewed this don't think that all these events are geopolitical events. But so anyway, we're going to give it a new name. And you can decide for yourself when we look at what the events are, whether these are actually geopolitical events or whether they're just events that shake our world. In fact, I suppose when you think about it, as a risk manager, you worry about a lot of risks. And then sometimes you worry about multiple risks happening at the same time. And maybe that's what we're really seeing here, a lot of different kinds of risks happening at the same time. So some of you may know the literature on multivariate volatility models. If you have a vector of returns and you want to know its distribution, conditional on past information set, it's got some conditional mean and some conditional covariance matrix. If you calculate forecast errors from this, these are the volatility adjusted forecast errors, they follow this equation, and there's the inverse of the square root of this covariance matrix in front of the unexpected returns. And with these forecast errors, we can immediately see that the variance covariance matrix of these forecast errors is supposed to be the identity. So this is a way often we check whether we have a good forecasting model for multivariate models. But it turns out that we've left something out by doing this. Yeah?
So is the underlying assumption here that these are Gaussian distributed?
No.
Or there's no...
No, that's not.
If you add... No assumption about higher moments.
No assumption about higher moments at this stage. And so what we know is that the covariance matrix is supposed to be the identity matrix. But what we don't know is whether these are actually independent, which is where you're going with your question. The fact that they're uncorrelated does not, of course, mean they're independent. And so an object we're going to talk about tonight is, what do you get if you square each of these forecast errors and then calculate the covariance matrix? That's where we see these GEOVOL kinds of events, because the square is large in all these assets at the same time. So they're correlated.
Does T stand for time?
It stands for time, yes. Each of these is a vector of across assets, but the T is the time. So basically, if we think that assets are going to have volatilities that peak at the same time, then it's really got to be the shocks that are correlated. Otherwise, there would be predictability, because one asset would go up and then it predicts another one. So things like vector autoregressions and volatilities aren't really going to do the job. We've got to have co-movements of these innovations, and that's what we're going to build a model of. So that's the story from sort of a statistical point of view. What's the story from a finance point of view? It's a little different framework, but it's the same question. So in finance, we think, okay, there are some factors. These factors are linear combinations of the same returns we're talking about, and these factors explain the correlation across stocks or across assets. And so there is an equation which says that the excess return on these stocks depends on the betas on the factors. And then there are idiosyncratic errors. And these idiosyncratic errors have volatility, but they're not correlated across cross-section, at least if you've got all the right factors in there. So once again, these idiosyncratic errors have an identity covariance matrix. So these are the same, these EIs are the same kinds of shocks as we had for the multivariate volatility model. But there are a couple more shocks in finance, which are the shocks to the factors themselves. So we want to think about the shocks not only for the idiosyncrasies, but also the shocks in each factor. And because the factors are regressors in here, it's natural that the shocks to the factors are uncorrelated with the idiosyncratic shocks. And if we rotate the factors to make them orthogonal, which we could always do, then they're going to be orthogonal, uncorrelated with each other. And once again, we get the same relationship here that I did from the multivariate volatility model. And we're going to ask exactly the same questions. Are these independent or just uncorrelated? And if they're just uncorrelated, then can we build a model of the dependent structure that preserves this relationship? So we want to have this be true for our data, but we want to have a richer model which tells us where the outliers are and how they move. Okay, so GEOVOL is a time series latent volatility factor. It has what it's going to do is going to drive asset returns in a way that makes them volatile all at the same time. High value of GEOVOL means that it's going to have that all these volatility models are going to be underestimating the volatility at the same time. And when we look at the events where GEOVOL is big, some of them are going to be political, some are going to be military or terrorist. Sometimes it's just a lot of really important economic news. So we might think of it as a kind of a generalized geopolitical volatility. So what are the properties we want of this? Well, what we want is that this, what I'm going to call this, this x, is it's a non-negative random variable. It's got a mean of 1 and a variance which is v, but might change over time. It's interpreted as a variance, and its square root is what we're going to call GEOVOL, because it's a vol, which is square root of a variance. So we think that there's a function g, which is specific to asset j, which depends on x, and the volatility of this shock here is gj of x. So when x is above its mean, the volatility is going to be above it, and when it's below its mean, it's going to be below. And we can write a potential data generating process this way, where we would say this would be actually an IID error term, might even be Gaussian. But what we observe for these residuals has embedded in it the same x for all j's. And that's where the power comes from. Okay, so we want this identity to be true, which means that the expected value conditional on x is just the gj. And so that says that the expected value of each of these has got to be 1, but when x varies, the conditional expectation is not always equal to 1. And what we're going to do is we're going to postulate some shapes and some unknown parameters and so forth in this g function, and then match those to the covariance matrix of the squares, which let's call this capital psi, and it's a potentially non-diagonal matrix. It would be diagonal, of course, if they were independent, but because they're dependent, it's got off-diagonal elements. Okay, so the first step is to find out whether, with some data, this is actually in the data. And so one way to do that is to build models, observe data on these E's, square them, look at correlations between different assets. And if you do this sort of a test of whether the squared errors are correlated, you of course have a lot of tests, because there are n times n minus 1 over 2 different elements in the covariance matrix of these squares. But the null hypothesis is that they're all 0. So actually, what we find is a useful way to do it is to do a 1 degree of freedom test, look at the average of the correlations, and test whether the average is different from 0. And what you see is, and I'll show you in a second, that these correlations are not that big, but they're all positive. And when you look at a test that the average is 0, you find dramatic evidence that there is this effect going on. So here's a little piece of a correlation matrix. These are actually rank correlations because it's when you're dealing with highly non-Gaussian data like the squared residuals, it's a little better to use a robust technique. So here are these correlations. You could test whether any one of them was equal to 0. But if you look at this corner of the covariance matrix, the most striking thing is that they're all positive. Because if these were really all just randomly different or close to 0, you'd have negative ones as well as positive. But they're all positive, which means that these assets all have high volatility at the same time. It isn't like one has a high volatility when the other one has a low volatility. They're all up at the same time. Okay, so what's the model we're going to look at? Well, we're going to let G be linear. We're going to let it have a factor structure so that we're going to say that Sj is the factor loading for asset J, and we're going to multiply that by x. But we have to adjust it so that the expected value of this is equal to 1. And so you need to add 1 at the end there. So now the expected value of Gj of x is equal to 1, which is what gives us the correct covariance matrix for these EJs, which are all supposed to have variance 1 and covariances which are 0. Okay, so this is a simple model. But it's got in it two new constructs. One is the factor loadings, and the other is this latent variable x. And so we have n factor loadings if we have n assets, and we've got t x's if we have a time series of these. And we have to estimate all that. So just to fix ideas, when x is large, all returns are likely to be bigger than usual. How much bigger than usual? Well, if x is 4 and s is 1, then the standard deviation of returns is actually twice what the model was expecting. If the factor loading is only 0.1, then it would be 1.1 times the expected factor loading. So now we have to take this model and see what we can do about estimating these parameters. So the first thing is to figure out what this covariance matrix actually looks like. So the diagonal elements are variances of squared returns, squared volatility adjusted returns, and that's shown on top. More interesting is the covariance, conditional covariance between these squared returns. And if you substitute in that it's GIT times the error term times epsilon squared, and epsilon is a IID 01 random variable, you get this kind of expression. You can work out exactly what it looks like. And here's the answer. It depends on the product of the two factor loadings and a constant, which is the variance of the latent factor. And this makes us recognize we've got a factor structure here. This looks like a one-factor model in a lot of ways. And so this is what we expect to see when we look at these the covariance matrix, these squared returns. Like the covariance matrix I just showed you, It should have an off-diagonal elements, which are the product of the factor loadings times the average variance of the GEOVOL plus the diagonal term for the variance of that, the fourth moments. Okay. But we can do better than that. One way is just to estimate that matrix. That gives us some good starting values, but we want to do something which is actually better at estimating these parameters. And to do that, we're going to add the assumption of normality on these little epsilons. We've assumed that they're independent, but now we're going to assume that they're also Gaussian to get a likelihood function. And here is the log likelihood function of the data for the parameters S. But in this likelihood function, we have an unconventional set of random variables, which are these latent random variables, the X. And so Hastie, Tibshirani, and Friedman actually call this a data-augmented log likelihood. So you put in this likelihood function, not just the data and the parameters, but you also put in some random variables that you don't observe. And then when you go to maximize this, you've got a problem because you don't observe all the data in it. You can't just maximize it in a straightforward way. However, a common strategy for this is the EM algorithm, or as they call it, a maximum and maximizing algorithm, which is to maximize this likelihood function with respect to the missing variables, and then conditional on that answer, maximize it with respect to the parameters. And then, of course, when you know those parameters, you go back and re-estimate what the unknown data are, and you can go back and forth. So we have two first derivatives. You'd like both of them to be satisfied at the same time, two partial derivatives. One is with respect to the parameters, and the other is with respect to the latent GEOVOL. So the estimation strategy here is to go back and forth between estimating factor loadings, estimating the factor, and then go back and forth till this thing converges, in which case you've got a solution which solves both the first order conditions. Well, it turns out that these two equations are actually very familiar. Sort of familiar. Familiar to me. I don't know whether they're going to be familiar to you. But this is the equation that you get from the first order conditions when you take the derivative with respect to x. And so xt here tells you that we have observations for different assets, but they all have the same xt because you do it for one time period. So you do a cross-sectional volatility regression where you're regressing this return on something which has got a heteroscedastic error, that the variance of this process is different for each asset because it's got a different factor loading but the same x. So now from that, running that little volatility equation, you can get an estimate of xt. Similarly, when you take the partial derivative with respect to s, it tells you to do a time series regression with all the xt's that you've found so far and see what the s is for each asset. So for each asset, you do a time series regression, and for each time period, you do a cross-sectional regression. And you go back and forth between those till you have till the parameters stop changing. And in finance, this is a little bit like the Fama-Macbeth model, but the Fama-Macbeth model is in the means, whereas this is in the variance. So it's like a variance version of Fama-Macbeth. Yes?
Could you please define heteroscedastic?
Heteroscedasticity. Okay, so when a random variable has got the same variance all the time, it's homoscedastic. When the variance is changing, it's heteroscedastic. So they don't all have the same variance. Why are they not having, did they not have the same variance? Because they've got different factor loadings on it. So you can use that information to estimate what the x must be. Because obviously if x is equal to 1, then they're all going to have the same variance. It's all going to be 1. So you can tell if they're really different variances, then the x is probably really big. Okay? Anything else? Okay. So, how am I doing? Well, in the paper, we've got 2 Monte Carlos and 2 applications. I've never seen anybody do a Monte Carlo that didn't turn out right. But everybody does them. So I'm going to try to do it super fast so it doesn't waste time, but you can see that it works. And then we've got a couple applications here. So first one is to test whether this covariance matrix is diagonal or not, covariance matrix of squared residuals. So this is the basic test as to whether there is kind of evidence of GEOVOL. Because if GEOVOL has a variance of 0, then all the off-diagonal elements are supposed to be 0. All these correlations are 0, and you can test them. And so here we have actually half a dozen different tests that we've done. But here we're running the tests with, I don't know, 6 different DGPs. And here, this is the 1% test, and here's the 5% test. So this is measuring, looking at the size through simulations. I think it's about 1,000 observations in each, and I don't know how many replications. And here is the power when v is, instead of being 0, it's equal to 1/2. And you see the power in this case is actually quite high. Basically, it's more important that the size is right. You don't know whether 1/2 is a far from the null or close to the null, but in any case, it clearly does have power in this case. The second part of the Monte Carlo is to ask, do we get good estimates of the parameters? And I'm going to show you what I call an R² of these things, because the parameters include these x's, which are not really parameters, they're random variables. So we can talk about the mean squared error of x, which is the sum of squares of x minus 1, the average of that. But we can also look at the mean squared error of x minus what we estimate. And hopefully this is a small number, which makes this R² close to 1. Do the same thing for the s's. And this gives us a way of saying, in some Monte Carlo experiment, how close are we to actually nailing these random variables and the parameters? So here are the results. First set of tables is for 1,000 time periods for 10 assets, 50 assets, and 100 assets. And the second half is for 5,000 time periods. And so here's the R² with respect to S. And what you see is that as you add more assets for a fixed time period, actually the fit gets worse. But when you add more assets, you're adding more parameters. So it's harder to estimate it. With the same number of observations, you would expect it to be more difficult to estimate. If you go from 10 assets with 1,000 observations to 10 assets with 5,000, you improve the R² and it gets quite close to 1. And the same thing is true for 50. How about the x's? Well, if you go from 10 assets to 50 assets to 100 assets, it doesn't actually help your estimate of the R² very much at all. goes up by a little bit. If you, let's see, if you add more time, then it doesn't actually, I guess here you would say there is an improvement as you have more assets. But if you just had more time periods, it doesn't help very much because then you have more parameters to estimate. You've got 5,000 x's to estimate instead of just 1,000, and that's a whole lot more. So in any case, the convergence of this has got to be in both t and n. That's the only way you're going to get both these parameters to get their r-squareds up toward 1. So now let's go to VLab. This is what you'd see if you go to VLab and you ask for the geopolitical risk. You'll see that today the geopolitical risk is said to be moderate. That is relative to its long historical value, and that is the x for today we're talking about. This is a plot of the rolling average of the x's, and these are the 5 biggest events over the last 2 decades. And you might already have had a thought as to what the biggest events are likely to be, but March 9th turns out to be the biggest one. And that's when Italy was all locked down, and at the same time, Saudi Arabia and Russia both started an oil price war. And so you could think of this as having both sort of a climate effect and a pandemic effect going on at the same time. Anyway, so that's the biggest one. Brexit's the second biggest, and 9/11 is the third biggest. So they're not, I don't know whether these are all geopolitical risks. There's no doubt Brexit would be interpreted as a geopolitical risk. I don't know what the pandemic is thought you would think of as a geopolitical risk. Terrorism. Some people think terrorism is the only geopolitical risk, but in any case. So that's what is going on. These next two are the February 27th, 2007. Most people in financial markets remember that day because it was really the harbinger of the financial crisis, which was on its way. In fact, when you look at the news about it, it was, Greenspan had some sort of warning. I remember that there was a Chinese crackdown on market speculation, that they were going to tighten the margin requirements. But anyway, and then the August 24th, 2015 was really the day that the Chinese bubble broke in Beijing, and that actually ricocheted around the world. Here's a plot of the whole 2 decades of GEOVOL, and kind of what you see is that although it goes up and down, it looks more or less stationary. And that's kind of what we would expect for this, because it's all got the same mean, and its innovations to volatility is what it's really measuring. So you kind of wouldn't expect much structure in this. The biggest event is March of 2020, and that's the one we just already looked at. But the second biggest event is the financial crisis. So if you wanted to really look at this, you turn the next page in VLab, and this has the top 20 events. And you look down this list, you'll see 1, 2, 3, 4, 5 COVID events are in this, which means COVID really played a major role in shocking financial markets all over the world. There are a variety of other things. Here's rumors of credit downgrade in 2011, which of course we've seen again and are going to see again, I guess. There is Trump's election as president, November 9th, 2016. There are several things in 2001 when the internet bubble basically burst, and you see various tech events that are there. So it's interesting reading, yeah?
Rob, your February 27, 2007.
Yeah.
If memory serves me, I was at the Richmond Fed that day for a conference.
Okay.
The news was just coming out that the mortgage servicers.
Use your seat mic, please.
Oh, yeah, why don't you?
The news was just coming out on that day that the mortgage servicers in the repo market were becoming illiquid. A lot of the repo is being pulled. So I'd want to verify that date, but I think that could be helpful to your story.
Yes, I would. I would like to have more there because it's, I remember that day, but what I remembered about it was this was when UBS's housing hedge funds were first rumored to be in big trouble, and so that's kind of consistent with what you were saying, and so I thought, that. But anyway, yeah, for another right. Yes. Oh.
Back to the Fama Macbeth.
Fama Macbeth.
I
Okay.
hate to admit that it's been over 25 years since I last worked with Fama Macbeth. There's a complicated portfolio sorting sort of process. Are you using something similar, but
No.
focusing? You're just saying theoretically or conceptually, it's similar.
I don't remember that there's portfolio sorting in Fama Macbeth itself. I think there was the portfolio sorting after you'd done your Fama Macbeth. It gives you betas on the portfolios and estimated values for the indices and stuff, and that's what. Yeah. Anyway.
It's been over a quarter of a century, which I would admit.
Well, we're not going to debate that. Okay, so what are the loadings? These factor loadings that we estimated? Well, the factors actually have the biggest loading. We have the ACWI in here and the first principal component of all these countries. This is now 47 countries plus the two factors, so it's basically 50 assets. Then France turns out to have the highest loading. Kuwait is the second. I don't know why that is. Spain, Italy, Germany, Netherlands, Malaysia, Belgium, and so forth. And then these are the bottom ones. And so this sort of seems like it might be relevant for the hedging problem. Because if these have a low factor loading, then, and you put them in your portfolio, then you're not going to get as much exposure to this GEOVOL effect as if you've got a high factor loading on them. It turns out that the loading needs to get multiplied by the volatility, because this is a percentage shock to the loading. And so if you give it a loading which is proportional to the estimated volatility of this asset, you get these factor loadings, and these are the ones that you would probably want to use to choose a portfolio which was relatively insensitive to this GEOVOL factor. Okay, I said there were two analyses. The second one is asset classes all within the US. So we're talking about, currencies, sectors, commodities, real estate, and so forth. Actually, the things that I showed you in that picture right near the beginning. And, well, it looks like it's pretty similar to what we saw before, although now it seems to be a little bit higher. I guess it's elevated right toward the end there. And the biggest events are 9/11, Trump's election, one of the big events of the dot-com bursting, when AOL was able to buy Time Warner. And here's COVID in the 4th spot and COVID in the 5th spot. But this is actually a good news event because this is when the vaccine was announced. Anyway, so, and here are the loadings for that. And here is a picture which I find a little hard to really grasp. What it is a picture. This is our measure of GEOVOL, and what's up here is our other people's estimate of geopolitical risk. So what do we have? We've got BlackRock in blue, and what it is that it's the innovation in BlackRock's geopolitical risk measure. We have the Baker Bloom and Davis economic policy uncertainty in green, and Jan Cavello and I've forgotten. The Fed, anyway, has this geopolitical risk index in purple. And what you see is some evidence that they're matching. Like here, in this big COVID peak, you can see the green one shoots up at the same time. And this is based on newspaper clippings and textual analysis of the newspaper clippings, which peaked at the same time. And I guess that's not too shocking because the newspapers are full of COVID at that point in time. Some of the other events, down seems to be matching here. This a little bit matches. This matches. So there's some evidence that they're similar. These are all monthly data. We're the only ones that do daily things. And the geopolitical risk index has its biggest peak in 9/11, and it turns out that's based on terrorism mostly. And so the terrorist aspect of geopolitical risk doesn't really show up during the pandemic. In fact, it has a big down peak here when we think the volatility is high. So I don't know quite what to make of this, but you can look at these pictures on VLab and maybe see where are some connections and where there aren't. So the question you've been all asking yourselves is, what can you do with these? So let's try to come up with some answers as to what you can do with it. Can you forecast GEOVOL? Well, because the square has a constant mean, it's not really very predictable. However, the variance is changing over time, so you can talk about tail events of the GEOVOL, and that's one of the things we do. In order to do that, you've got to measure the variance over time, but it also does appear that the rolling windows have some cycles in them. And so I think there's some long memory effects in GEOVOL which are not taken out by all the time series structure. So there is some evidence, I think, that there is some predictability here that could be useful. What about hedging? Well, the standard ideas of diversification don't work, right? Because this is so generic. So is there some kind of version of that would work better? So I'd like you to contrast this with a Markowitz portfolio. And let's just do this in a really simple case. Let's think about a 2-asset portfolio where they both have the same conditional mean and conditional variance. They're uncorrelated with each other, but one of them has GEOVOL and the other one doesn't. Okay, so Markowitz doesn't see GEOVOL because it's only looking at second moments. And so the 50-50 is what you'd hold for this asset. That would be your efficient portfolio. And so your Markowitz efficient portfolio is going to be exposed to GEOVOL and have high tail events with some probability. It's kurtosis, but it isn't just kurtosis. It's all the high moments, because the tail events in GEOVOL can be arbitrarily big. There's no restriction on that. So it might not be such a good portfolio to have a Markowitz portfolio there. So maybe what you should do would be to tilt your portfolio to reduce the exposure to GEOVOL. And so you might think of about the portfolio problem as being minimized portfolio variance subject to expected return, which of course we're familiar with, but also subject to exposure to GEOVOL. You might just formulate that as a problem, and K2 is a parameter in your portfolio choice problem. And in which case you would certainly reduce the probability of tail events, and but you would have a little bit higher variance than the Markowitz portfolio. So this might be a good trade-off. A second kind of thing you can do, and I guess as you do this, you're going to find that you're going to tilt your portfolio toward these assets which have low variance weighted loadings. And those would have a little bigger role in your portfolio than in the Markowitz portfolio. And that's kind of what you're going to see. If all these factor loadings are equal, then it doesn't do you any good. Then you're not going to be able to tilt away from it at all. So these loadings turn out to be the key part of the portfolio problem. What about finding climate events? So, I mean, I said we do a lot of work on climate, and I'm just going to give you a peek at it. But one thing you could do with climate is you can do the same analysis with funds which are considered to be climate sensitive funds. And we follow almost 200 of these funds, and we have a lot of properties on them every day, and we form portfolios of these funds which have characteristics which we think a green portfolio should have, and we could spend an evening talking about that. But what I want to show you is something slightly different, which is suppose we applied the GEOVOL method to these climate portfolios. Then the events we're going to find are going to be the events which shake all these climate portfolios. And what we're going to do is we're going to take out risk factors, which we always have to do, and we're going to take out, if I'm a French three-factor model, we're going to take out two different factor mimicking portfolios from the climate business and an oil price factor, and one stranded asset portfolio and factor mimicking portfolio, and then look at where the big shocks are. And this is just a sort of a quick summary. I mean, I don't really think I've done this very carefully, but it suggests these are the factor loadings on these portfolios, and some of these might be familiar, but the highest factor loading is the Domini Impact Equity Fund, which has also been around the longest, but the factor loadings come down. So they are going to be most exposed to climate events, which actually might be a good thing, because the climate events are events that these are designed to hedge. And these are the dates. And I haven't done an analysis of the dates, but I don't really recognize a lot of them on there. A second thing of climate is a paper by my co-author, Susanna Campos-Martins and David Hendry, which looked at the geoclimate geopolitics, and the geovolatility of carbon-intensive asset returns. So what they did is they looked at oil and gas stocks from all over the world and said, okay, let's put these into the GEOVOL algorithm and see what events come out. What are the events which move all these energy markets? And here's kind of what they come up with. And they've gone back a long time in history. So you can see they've got 89 as the first event. But they also look at what happened to the stock market, price of oil, price of energy, and just average market return on these dates, which is kind of an interesting thing to do as well. So in any case, it's interesting to try to figure out what are the climate sensitive dates, because if you're trying to create a climate hedge portfolio, you've got a trade-off. You've got your portfolio is what you want this portfolio to do is to outperform if the climate gets a lot worse, and underperform if the climate doesn't get bad, because you want to pay off in bad states of nature. So that means it's a risk-reducing portfolio for you, and it therefore probably has a negative risk premium. However, that negative risk premium gets offset if the market has new information that the climate's getting worse. So whenever the market learns that the climate is a bigger problem maybe than it thought it was, then this portfolio should appreciate. So you expect positive alphas when there's climate news and negative alphas when there's no climate news. That's kind of the asset pricing theory of climate hedge portfolios. So here's a place we've talked about finding climate news. Those two approaches might tell us where the climate news was important. We've been using newspaper stuff, but this other approach might be interesting as well. So if we can use this approach to find even better climate hedge portfolios, then, well, we could invest in them. But one of the things we could also do is see whether some other portfolio is correlated with it, and what its beta is on this. That would tell us something about how good a hedge it was for these climate sensitive events. And we could ask whether our banks are overly exposed to these events. And this is something that central banks all over the world are trying to figure out how to do stress tests on climate. And this apparatus that I've shown you tonight, I think, can be part of the story for how to do that. And we are currently using not a portfolio that I've shown you tonight, but a portfolio which is a stranded asset kind of portfolio, pretty simple, to try to look at what the bank betas are on this portfolio and allow these betas to change dynamically, because volatilities and correlations are changing over time. So we use something we call the dynamic conditional beta model. And I'm going to show you one page of results. And this work is being done in collaboration with the Fed, with the European Banking Authority, and the Inter-American Development Bank, each of whom has a different jurisdiction and is interested in how their approach compares with ours. And so here's what you get for the betas for the large British banks. And you can see that they're jumping all over the place. It's not a smooth picture. On the other hand, there are a lot of things happening. I think there is a change in people's attitude about climate risk, and that would change these betas. And there is probably a change in the holdings of these banks, which would affect it, and there's probably a change in regulatory expectations, because the regulations are changing in Europe pretty fast. In any case, here is zero. So at zero, the climate effect on these banks isn't there. So the market mostly views British banks as having positive betas, climate betas. And if they have positive climate betas, that means that a climate event is going to hurt the bank. And so when you ask in a quantitative way, how much would this lower the market cap of the bank, and does that lead to a capital shortfall? We can calculate that for any particular scenario on these climate portfolios. And especially here in the end, in 2019 and 2020, the betas have gotten quite big, and it appears that there is some possible financial instability, financial fragility that the regulators worry about.